Hello friends, this is Raj Sastry from Raj Option Trading. Today is July 26, 2021. I want to cover stock and option purchasing ideas for the week of July 26, 2021. With that, today we will talk about Ttm Squeeze, a indicator by John Carter. This will give a very good idea when to buy stock, call or call option or call spread. So with that, let's jump in here and get started. You might wonder, what is TTM squeeze? TTM squeeze is a volatility and momentum indicator introduced by John Carter. It tells you when a stock is going to break out strongly after consolidating in a tight range. Think about any stock that stays in a tight range for a long time. You feel like you're wasting your time. But this indicator will tell you when it's about to break out. That's when you can buy some and really position yourself for a good upsize gain. TTM squeeze indicator measures relationship between two studies, the Bollinger Bands and Kelton channels. When the volatility increases, so does the distance between the two bands. Think about Bollinger Bands. When there is an increase in volatility, that's when the distance between the two bands will increase. And when volatility decreases, the distance between the two bands also decreases. So the squeeze itself takes advantage of quiet period in the market when the volatility is decreased significantly and the market is building up energy for its next major move, higher or lower. The key is to really understand whether it will go up or low by looking at few sets of indicators. And TTM, the quiet periods are identified when the Bollinger Bands narrow in the width to the point where they're actually inside the Keltner channels. This marks the period of reduced volatility and signs that market is taking significant breather, building up the energy for next move. So this is very important to understand. John Carter's indicator will tell you by showing the red dots when this happens. The trade signal occurs when Bollinger Bands then move back outside the Kelton channels. The red dots indicate tight compression of volatility. The first green dot in a series of red dots indicate the energy is about to be released. This is very important. Wait for the first green dot that tells you energy is about to be released. And then also, if you look at the waves, this is also important. You have to look at the longer term C wave. If the longer term C wave is above zero, when this happens, then go long. I mean, buy stock, buy call option or call spread. But if the longer term C wave is below zero, then go short, buy put options, buy go short, or something along those lines. So with that, what is a wave? So A wave measures the short-term trend. For example, here, when the A wave crosses above zero, then it's a bullish sign. In the A wave, when you see a yellow bar, that's bullish. When you see a red bar, it's bearish. We'll go into a little more details when you look at the chart. And the C wave is a longer term trend. The light blue bar is bullish and the dark blue bar is bearish. The TTM wave study represents the combo. There is a wave, we call it wave 1 plot, and a C wave, which is a wave 2 high and wave 2 low plots. This is Think or Swim by 3D Ameritrade. And the best squeeze are the ones that fire off in the direction of C wave. So we will look at this in the chart. I will explain this as I go through. So with that, let's jump in here. So here are the list of stocks, with this indication here. And as I go through here quickly to look at least the methodology here, I got the stock itself and the name of the company, the current price, market capitalization, sales and sales acceleration. It's very important to have for a company to have good sales growth. For example, Cleveland Cliffs here, nice sales growth in 1 year and quarter over quarter. Also look at the companies with nice gross margin. In this case, Cleveland Cliffs has got 6%. It's positive. I will take it. And then as you look at here, we got the ownership from a big institutions, the short ratio. The moment there is a high short ratio, there's a chance this stock can, you know, result in a squeeze. And then we got price to sales ratio, which is a valuation indication. Then the IV percentile, that will tell you where is the volatility low at this point or high. A IV percentile of 24, that tells you volatility is low. Typically a IV percentile below say 45 or so indicates a little bit lower volatility. The moment it goes above 50, that's when it's a high volatility. Then we got RSI. RSI will tell you is it good to buy at this time, you know, is it oversold or overbought. Anytime RSI is below 50, it's oversold. You can enter safely. And then we got volume, very important. All the stocks I covered today have got very good volume, at least above 1 million shares traded on last Friday. Then we got John Carter's TTM squeeze indicators. We got 1 day, 3 day squeeze, 1 week squeeze, and 1 month squeeze. Anytime you see a Y in these columns, for example here, Cleveland Clips has got a Y in 1 week, that tells you there is a weekly squeeze. This weekly squeeze can last for a couple of weeks. It's a longer term trend. Whereas daily squeeze, for example, here we got Honeywell, that's a daily squeeze. This squeeze can last for a couple of days. So it's important to understand the weekly squeeze, daily squeeze, and monthly squeeze. Monthly squeeze will tell you, hey, you know what, there is a longer term trend going on here. This trend can continue for a couple of months as an example. Then we got earnings date. Earnings season is upon us, so we got to be very careful to trade around the earnings. Look for the earnings date here. For example, here United Steel here earnings is 729, which is around the corner. So you got to pay attention here. Around the earnings, stock will increase in the volatility. Stock can go up and down drastically. That's something to keep in mind as usual. Then we got the 1 month performance, 3 month, 1 year performance, and finally how much the stock is off from 52-week high. So it's very important to understand where the stock is at. Typically, if you're a buyer, you don't want to be buying when it's at a 52-week high, unless there is a very good indication there is a secular trend that will continue. So with that, what we'll do is we'll look at a couple stocks here and see what's the opportunity here. And first we'll look at Cleveland Cliffs, ticker symbol CLF. So with that, I'll go to Thinkorswim here and bring up CLF. So as you see here from a CLF chart perspective, I got here 1 day, 1 year chart, which is, you can think of it as a short, nearer term or a shorter term. Then we got 2Y, 2 year and a 3 day chart, a little bit longer term. And we got 5 year weekly chart and a 10-year monthly chart. That tells you in the horizon what's going on. As you scan through this here, you see here on a daily chart, it's showing bullishness, and the same story in the 2 year chart. 2 year chart tells you, hey, you know what, it came from a lower point. That tells you, what's going on here. And if you look at a 5 year chart, it tells you it did not do well for a long time, but it caught fire back somewhere here in 323 2020. And as you look at the monthly chart, it clearly tells you this stock has got a long way to go to catch up from the previous high. It was as high as $91, back in early 2017 or so. So we will give you a good range of what's going on, where the stock is coming from, where it might be headed to. And now if you look at the Ttm squeeze indicator, as I scan through here, I see squeeze forming here, meaning there are red dots here. That tells you there's a tight compression here and volatility is really low. The Bollinger Band is inside the Keltner channel here. As you scan through here, like we talked about, this is the A wave, which is shorter term wave. In the A wave, I see the yellow bar is below zero. As you can see here, this is the zero line. Yellow bar is below zero line. That tells you, as of now, per A wave, it's a little bit bearish because line is below zero. At the same time, we got a yellow bar that tells you there is some strength going on here. Still, the line is below zero. It's a bearish when it comes to A wave. But C wave tells you a different story. John Carter asks us to look at the C wave. C wave is clearly above zero. That's the bullishness. So John Carter tells you, hey, you know what, don't worry, go long here. So this is where we can look at a long trade here. Then as you look at the 5-year weekly chart, we got squeeze forming here, meaning at this point the Bollinger Band is inside Kelton channel, and we got a red dot here. And as you look at the A wave, shorter term A wave, it's below zero, a red line showing some bearishness. But if you look at the longer term C wave, this is what we have to pay attention to. That's clearly above zero. So John Carter says don't worry about short term A wave, but trade in the direction of the C wave, which is longer term. So clearly, per this indicator, we could go long here. And there is nothing going on in the weekly chart, so we are clear there. Clearly, from a setup perspective, this is a great setup. You could go long here. What typically I also do is I see what happened in the past. For example, if I look at the past here, we got a squeeze here, and as you scan through what happened, stock went up here, nice upward move. When this squeeze happened, we got A wave, which is above zero, C wave trending to go above zero. So that's when we had a nice acceleration here, and we had one more squeeze over here. And as you see here, when this squeeze happened, the A wave, shorter term A wave below zero, C wave is above zero, you got a nice acceleration again. So the story could continue. That's why we can look at the history and see how the stock behaved for the squeeze in the past. And if you look at the weekly chart here, you could do something similar. We got a squeeze here, and A wave is above zero, but C wave is below zero. Stock went down promptly because C wave is below zero. You got to trade in the direction of C wave. We got one more here, same story. We got compression. Shorter term A wave is above zero, but C wave, longer term C wave below zero. Promptly stock came down. So this is where you got to trade in the direction of the longer term C wave. But now as you see here, C wave is above zero, and now we got a squeeze. This should be firing on the longer side. Stock should go up here. So with that, let's look at one more chart here and see what's going on. So as you scan through this year, this is a 1 day, 1 year, 1 day chart, a little bit shorter term. Nice looking chart. I love this chart here. Stock is trying to go above some of these moving averages here. As you see here, it's breaking away from 50-day, 25-day, and even shorter term 10-day or a 9-day moving average. So that's a bullish sign here. And as you scan through here from a on the balance volume, it's trying to go up. That's a good sign. RSI, relative strength index, is gaining momentum here. That's great. DMI, which is a directional indicator that tells you anytime the blue line can cross over the red line. So right now it's bearish, but it can turn into bullish anytime. And as you look at the check-in money flow here, it tells you smart money is flowing into the stock, which is a good sign. And if you look at the volatility here, volatility is reduced. Typically this happens because Bollinger Band went inside the Kelton tunnel. Two Bollinger Bands are very narrow at this time. That's why volatility itself is very low. And IV percentile is 23.6, that's very low. So this is where, because volatility is low, you could buy the stock outright, or you could even buy call option or a call spread. So with that, let's jump in and go into option chain here. So if you look at the option chain, Cleveland Cliffs, if you're a stock trader, don't worry too much, and you could buy the stock outright, $21.50, 57 cents. Stock was as high as $24.77 in 52 weeks. You could just click on it and buy some stock and go from there. But if you don't want to buy stock outright, you could look at buying option. So option, I would like to give myself good enough time. Right now I would go 179 days out, which is a good enough time frame, and I would go delta 70 call option. Here um, we got here 18 strike price. I would go here and I would buy this right here. So I'm paying $5.90, and if I click here, my profit potential is infinite. Delta is 73. That tells you every dollar move the stock makes, option will move by 73 cents up or down. So this is a good way of buying, because when you buy stock outright, you're paying $21.50 or 57 cents per share, whereas here you are paying just $5.90 or $5.90 to control same 100 stocks. Only thing to notice here, break-even price is 23.90. Stock has to go above 23.90 for you to break even. Otherwise, you might end up losing your money on the call option. So this is one way to play. I think it's a good strategy. But if you don't want to buy call option outright, you could look at spreads. If you want to buy spreads because stock is at 21, you could basically look at 15-25 spread. So you could go here and buy a 15-25 spread. There you go. And you're paying $4.90 for this spread also. So you could confirm and send here. You're paying $4.90 to make $5.10. You're more than doubling your money. And here your break-even point came down, as you can see here. It's 1990. It's well below the current stock price. That gives you some cushion, so that way you have some margin of safety here. So this is a good way to play if you don't want to pay too much money, and also you want to play conservatively and have a lower break-even point. So this is a good way to play. You could confirm and send. So with this, if the stock stays above 1990 by the time 21 Jan 22, you will make money. Otherwise, you will lose your money. But you don't need to wait till 21 Jan 22. As the stock goes up, as you make some money, maybe say about 50% or so profit, you could just sell this spread and make money. So with that, let's jump in and look at maybe one or two more stocks here. As I scan through here, we got United States Steel. Looks like the steel industry is doing well now. That's why all the steel stocks, CLF, X, ArcelorMittal, all these stocks are doing well. I'm sure stocks like even other steel stocks are also doing well at this time. So as you scan through here, you got a couple more here. We could look at I have highlighted few stocks for you to look at. For example, Marathon, MT, AMAT, everything in the a gray background here are the ones where there's a good chance this can squeeze on the higher side or a bullish side. So as I scan through here, let's look at one or two here. Probably let's look at CVS Health. CVS Health is $83 stock. It's 8% off from 52-week high. And it's got a weekly squeeze, as you can look at here. So with that, let's go back here and let's bring up the squeeze chart and provide CVS. So if you look at CVS here, we got weekly squeeze per the indication, but I don't really see a weekly squeeze here, but I see a daily squeeze, as you can see here. When the squeeze is happening, as you see here, the shorter term A wave is above 0, and the C wave, which is longer term, is also above 0, even though it's a little bit bearish, but it's above 0. So as I scan through here, 3 days there is nothing going on, weekly there is nothing much going on, but as you see here, the bar is above 0 in the 3-day, bar is above 0 in the weekly chart, and same with the monthly chart. So I would think this will be firing on the longer side. So we could look at a shorter term chart, I mean a smaller chart here. So as you scan through here, so on the balance volume is telling you nice looking volume, that's a positive sign. And as you look at the RSI, it's a bullish, that's a good sign. And DMI is trending up, that's a good sign. At any time it can cause a bullish crossover. The blue line can cross over the red line anytime. And there is a nice check in money flow, smart money is flowing into the stock. It tells you, hey, you know what, if you want to buy stock or call option, good to do that. So with that, let's go into option chain here and give CVS. So CVS is a $83 stock, and as you see here, it all-time high is 55.36 in 1 year. Nice trading volume here, and as I scan through here, it also pays good dividend, as you see here. So with that, if you want to buy stock outright, you could just click here and buy some stock 83.48 and go from there. But if you want to buy options, you could look at 116 days out, expiration 19 November, and you could look at Delta 70, which is right here, pay $8 here, and buy the call option expiring in 19 November. So you are buying a call option at 77.5 strike price, and your break even is 85.50. For you to make money, stock has to go above 85.50, which is a couple dollars above the current stock price by the expiration date, which is 19 November. So you're paying $800 here. Your profit potential is infinite. As stock goes up or down by $1, your call option will go up or down by 70 cents. That's what delta is indicating here. So you could send this and make infinite profit as the stock goes up, or you could lose your money if the stock goes below your break-even point here, right here. So, but if you don't want to play the option, single option, you could buy a call spread. Stock being at 83.27, you could probably choose a $10 wide spread. So you could probably, I'm trying to think through here, you could do 70-80 spread, or even you could even do 72.5 82.5 spread here. So that could be a better one. Trying to see what's the best here. 75, you could even do 75 85, or even 77.5 87.5. That could be better bet here. Let's try that. 77.5 87.5. So if I do that, all right, so we are buying a $10 wide spread, so we are paying $5.38. Remaining portion of $10, which is little below $5, is your profit potential. You are not doubling your money here, but you are almost doubling your money. If I confirm and send here, I'm paying $538 here to make 462. My break-even point is just below current stock price. So this is one way to play. You are almost making, doubling your money, and your break-even point is below current stock price. But if you don't want to pay, too much into this trade, you could even play a lower $5 wide spread. Stock being at 83.27, you could do 80-85 spread, which is a smaller spread, and you could go from there. So 80-85 right there. So if you do this, you're paying $2.70, and remaining portion of $5, which is just below 250, is your profit potential. You're almost doubling your money, paying 270 to make 230. Your break-even point is below current stock price. This is the other way to play. You don't put too much money to work. At the same time, you're not losing too much money, and this is the other way to play if your account size is smaller. And of course, if you're a little more bullish, you could do wider spread. One of the best spread, wider spread you could do is you could buy 70-85 spreads. For example, here, 70-85. So if you do something like this here, you're paying $10.60 and remaining portion of 15. I think it's not a great risk reward here. You could do 17.90. That could be better risk reward. $20 widespread here. So if you do something like this, you are paying $12 and remaining portion of $20, which is a little bit below 10 is your profit potential. You're paying um, you're paying 1232 to make 768, but your break-even point is lower. Looks like risk reward is great, not great here. You could stick with other strategies that we talked about. So with that, let's go into one or two more here. We got Honeywell. I like this stock. This is a great stock. Just 9% below, 2% below 52-week high. As we scan through here, we got Raytheon, one of my favorites. That's also doing well. We could look at Raytheon RTX. So if we go back here, RTX. So Raytheon, as I look at the squeeze chart here, nice looking chart. We got a daily chart, 3-day chart, weekly chart, and monthly chart. And we got squeeze forming in the daily chart that tells you in the daily basis the Kelton channel, the Bollinger Band is going inside Kelton channel. And right now there is a compression, there's a low volatility, there is a lot of compression going on. And as it happens, the longer term A wave is above zero. That's a bullish sign. We got a squeeze forming in the 3-day, 2-year chart. Same story here. Longer term C wave is above zero. That's bullish. As I scan through here, A wave is above zero. C wave is above zero here in a weekly chart, and same story on the monthly chart. And if you look at the history here, we got a squeeze here. A wave is above zero. Stock went up. Same here as you scan through your squeeze here. A wave is below, C wave is below zero. Stock kind of traded sideways. And then we got one more squeeze here. A wave is below zero, C wave is above, stock went up. So historically this stock did well, responded well to the squeeze. So you could look at a different chart here and see what's going on. Raytheon, nice looking chart as you see here. Stock is trying to decide where to go from here. Nice on the balance volume. RSI is pretty good, 50 right now, midpoint. DMI is telling you it's trying to decide where to go. There's a chance the blue line can cut over red line. There's a chance, but right now it's mildly bearish, as you can see here. Nice volume, check-in money flow, smart money is flowing into the stock. That's a bullish sign. So with that, let's go to option chain here. So $85 stock here, all-time high was 89 in last 52 weeks, and it also pays nice dividend, as you can see here. If you're a stock purchase, if you're a stock person, you could buy the stock outright by paying $85. Not bad. And if you want to buy options, you could look at 16 days out, do delta 70 option right here. 69 or 78 both will do. You pay $8 and 5 cents and confirm and send. So your break-even point is 88.35, just above the current price, and your max loss is 835, the money that you paid. Every dollar the stock moves here, the option will move by 69 cents because it's 69 delta. If you don't want to pay so much money, you could buy spreads here. Stock being at 85.81, you could do 80-90 spread here. So as you scan through here, 80-90 spread, I could buy this spread right here. There you go. So you're paying $5.35. The remaining portion of $10, which is $4 and 65 cents or so is your profit potential. So you could confirm and send here. You're paying $5.35 to make $4.65. Your break-even point is just below the current stock price, a little bit conservative than previous strategy. You could confirm and send. So This is one way to play. Let's go back here into the PowerPoint. So we got a couple more here. You could look at all these things where there's a gray background. Exelon as an example is a great stock. Doesn't move too much. If you're a stock buyer, you could buy this for a nice dividend and hold for a long time. And same is the story with a stock called O. Ticker symbol O. That's also a good one when it comes to dividend. And as I scan through here, we got one more page. We got Sanofi here. Sanofi has got a 3-day squeeze and a 1-week squeeze, and it's just 4% below 52-week high. Could be a good one to buy. And we got Monster Beverage. It's a good one here. And as you scan through, we got a couple more. 3M, Network Appliance, Yum, which is a good company. Restaurant brands, nice restaurant stock. We got Skyworks, earnings is up later this week, and it's making a monthly squeeze, as you can see here. So let's look at Skyworks just out of curiosity and see what's going on. SWKS. And as I scan through Skyworks here, so there is a squeeze forming the daily chart. A wave is above zero, coast is clear, you could buy on the longer side. And as I scan through here, so we got the squeeze, and there's a dot, green dot here. Basically the squeeze has fired at this point, and also Bollinger Band is getting outside of the Keltner channel. Longer term wave, C wave is above zero. That tells you coast is cleared, you go buy. And also the longer term weekly wave is above zero. So you could, it's a nice setup here. You could buy call or stock itself. And if you look at the chart here, different chart, on the balance volume is nice, positive, that's great. Check-in money flow is 62. That tells you stock is not oversold at this time. It's in a good range, you could buy. And DMI tells you it's nicely bullish. See the distance between the blue line and the red line, it's very pretty significant. Right now stock is bullish, and the volatility here is 66.7. The earnings is coming around the corner. That's why if you're an options trader, I would say don't buy the call option here, because if you buy now you are paying higher price, 67.7 volatility. But if you want to do spreads, you could do, because you are selling one, buying one. It neutralizes your impact of volatility to some extent. But I would not recommend buying the call option outright. But if you're a stock purchasing type person, you could buy stock outright. You don't need to worry too much about volatility here. So with that, let's go to option chain here. Skyworks, you could buy stock outright, 193.45. You could do that. But if you don't want to do that, you could do spreads. If you want to do spreads, 192 here, you could do 185, 195, spread $10 wide. So if you go here, buy 185, 195, so it's a $10 wide spread here. So if you do that, you're paying 568. Remaining portion of $10 is your profit potential. You are almost doubling your money, not quite. You could confirm and send. If you do this, you're paying 568 to make 432. If the stock price stays above 190 by 19 November, you'll make money. It's one way to play. But if you want to do a bigger spread, you could do 185 200 spread, $15 wide spread. If you do that, you're paying 778, and here I think you got more than double potential here. You could confirm and send. You're paying 778 to make 722, not more than double, it's almost double. This is the other way to play. Your break-even point is just above the current stock price, barely above current stock price. So with that, let's go back here. So in a nutshell, these are the two pages here. According to Ttm Squeeze Indicator, you could buy stock the call itself or call option. Look for IV percentile. Typically buy when the IV percentile is below 50. Those are the good ones if you're buying call or call spread. But if you're an options trader, don't worry too much about volatility, and you could buy the stock outright. So with that, thank you very much. Happy investing and trading. Please subscribe.